and welcome everybody to the Thursday night stock and option webinar. Super happy to have you guys here. I want to talk about two things today. Number one, we want to talk about a little bit just kind of the state of the stock market, and we'll kind of do that towards the end of the webinar. But I want to, or maybe at the beginning. I don't know. We'll see how it goes. But I also want to cover uh, a pretty important principle. So for our trading strategy that we're using for our stock and options trading strategy, a lot of people have expressed to me that they're fairly unclear on how to calculate where your break-even price is, what your cost basis for a stock is once you get assigned from a credit spread. So some of you will say, "Yep, I got it 100%." And for those of you that do, my apologies, because this will be some repetition, but it's literally been something that has come up at least every day this week, where people have said, "Look, honestly, I ask everyone outright. I say, can you calculate where your cost basis is for a stock once you get assigned, from a credit spread, from an option play?" And honestly, probably 10% of people I talk to on a regular basis can accurately calculate that. 90% still have a really hard time, which by the way is great. And so if you're one of the 90% that's having a hard time calculating the break even, you're in good company, because apparently everybody is kind of struggling with it. So we're going to spend some time. I did want to kind of dive into a couple of other things today, but I don't want to move on to things that we're not ready to move on to yet, right? I want to make sure that the whole group is really crystal clear on, that ultra important principle of where is our break even? Where is our break even? How do we calculate our break even? Such an important concept. Does everybody feel okay about that? If I see like 10 people log out immediately, I'll know that you're pretty good on break even and you don't want to hear it again. But even for those that are comfortable with calculating your break even, there will be a few things to look at that we can kind of take a little peek at and see if there's some additional kind of learning that we can do here. But remember, guys, it's such an important element of the strategy. We need to know how to get into these kinds of trades, and we need to know how to calculate our numbers to determine if we want to stay in this kind of a trade, right? So it's probably one of the most important things we can do or talk about. I just feel like I talk about it so much that I don't want to bore people, but then it kind of came up that people still are having a hard time kind of understanding it. So I'm happy to review it again, and we'll go over the details. So okay, we'll get it going. All right, let's see. Yeah, Peggy, good comment. I like that. Okay, Sharon. All right, absolutely. From Sharon. Mel, once I place the trade, I find it difficult to determine what is going on. I'm new to Tastyworks. Forex is simple. Mel, that is for sure. Forex, currency trading, that's, it's so easy, right? We just are long a contract or short a contract, super easy. But option trading, whew, what a situation that is. But the more you do it, the easier it gets. And the things that we're going to focus on are actually super simple. So it's all pretty good stuff. So we'll focus on the easy peasy stuff. That's what we'll talk about right this moment. Okay, so let's just get down into the numbers, and let's see what's going on here on these numbers, on these details here. When we place a trade, remember, guys, there's a couple of there's a couple of details that we've got to look at here, right? People ask me, how do we determine taking a trade, and what do we do there? And remember, once we take a trade, we are simply waiting to see just one of two things. Is the market going to go up? Is the stock that we're in going to go up, or is it going to go down? And that's going to kind of determine what our strategy is going to be. So I'm going to kind of run through things here a little bit, just because these are things that are coming up constantly. So we need to be able to calculate break even, but we need to also be able to kind of calculate where are we trying to do something. So Let's take, for example, here's a group we have or a trade we have in the trade group here, right? Which is KHC, the good folks from Kraft Heinz. We like ketchup and mustard and all things crafty. So we got assigned on Kraft Heinz, right? We got assigned because I sold, and let's go to activity here. And I'm going to go back 60 days. I'm going to type in KHC. So for those, and I think pretty much everybody's on Tastyworks here. If you're not on Tastyworks, daggone it, you should be. I think that all other brokers are terrible. So Tastyworks is my favorite. They're really, really great. So here's a trade that I recently did, right? I can see all the details right here in my history zone. And so remember, a credit spread, let's pull out the old trusty calculator here. A credit spread is when we sell a put at a higher price and we buy a put at a lower price. So you can see I sold a KHC 10/9 expiration 32.50 put. I sold a 32.50 put. I bought a $32 put, right? Now the difference between each contract is going to be my profit if the option trade runs in my favor, right? So I was paid $1.22 per option, $122 per contract. I was paid $122, but I had to pay out $98 because the $32 option is my protection, right? I'm selling the higher price, buying the lower price. The lower price is my protection. So I'm selling that higher price, and that's where my profit is, but I got to pay out $98. So I make 122, but I got to pay out 98 bucks for protection. That's my long put. So now I can make $24 on this trade per contract if it goes above and stays above 32.50. Right? Are we all good on that? That's a credit spread, right? A credit spread looks like this. If I think that SPY is going to go up, I'm going to sell a put and I'm going to buy a put. And if it ends up above here, this guy expires worthless and this guy expires with max profit, and that's what we're kind of talking about here. That will expire with all profit of 122 bucks, and that'll expire with all loss. I'm going to lose all my $98 because that's my protection. So that's why I end up with 24 bucks. Does that make sense? Does that explanation make sense so far? Is there actually, maybe don't tell me if it makes sense. Tell me if it doesn't make sense. Is anybody unclear on that part so far? We're selling a higher price, we're buying a lower price. If the stock expires above our highest strike price or our short put, we end up with max profit. This, our protection, the put we bought expires worthless, and the put we sold expires with max profit. So we make $122, but we lose 98. We end up with 24 bucks per contract. Good? We all good? Or is anybody not good? Let me know. Let me know, because this is going to be the foundation of it all. So we've got to make sure we understand that little part right there. So is everybody 100% okay? Mel says, if we don't understand, we probably don't know it. All good. Okay. All right. Mary, all good. David, 100%. All right. What was the 24 from again? Okay. And do you calculate the premium? Okay. So Lori, the 24 is from, we're paid $122, but we pay out $98 for protection. The difference between those two is our profit, 24 bucks. Does that make sense? So we're paid 122 and we pay 98. So that's where our 24 comes from. Peggy, do we calculate the premium? I'm not sure what you mean by that. Type a more detailed question. I'll be happy to answer that. Okay, so now that is our trade, right? If the stock starts to go, remember, we need this to stay above 32.50 for us to make that $24 per contract. If it starts going down, here is KHC. You can see that KHC is currently trading at 32.30. And my option obviously expired. My expiration was 10/9. So it certainly was not above 32.50 at expiration. So what ends up happening now is the stock goes down at, Janae, yes. I think, yeah. Yeah, and Peggy, if that was your question, $24 is the premium. Yeah. But that's how we calculate it, is by how much we pay out versus how much we get paid. We pay out 98, we get paid 122. Difference is 24, that's our premium, that's our profit. Okay, so the stock starts to go down and our $98 protection starts to gain value, right? It starts to gain value. So we paid $98 for this long put. Remember, this is a long put. This is a buy to open put right here. And if we just simply buy a put and a stock goes down, we make money, right? So even though this buy to open put is part of a spread, it still does what a buy to open put does, right? Long put, which means if the stock goes down, it makes money. And this is a long put. We're buying a $32 put. We're short the put at $32.50, but we're buying the put at $32 for $98. And so then the stock started going down. And so what I did was I closed my $32 put, right? I closed it right here. I bought it for 98 and I closed it for 135. So there's $37 in profit right there, 37 cents per share of option or stock. So I make 37 bucks, right? Is everybody clear on that? So I bought it for 98, I sold it for 135. Okay? So what we want to try to find out is this number doesn't change. We get paid $122 or 122 bucks. We get paid 122 to sell an option. That number never changes. When we're on the sell side of an option, whatever you sell an option for does not change. When you're on the buy side of an option, that number does change a lot, right? In this case, I bought it for 98 and I was able to, because the stock went down, I was able to sell it for 135. So this number is 122, and our question is going to be, how much of that 122 do we get to keep? And can we add to that 122? And that's where our buy to open put comes in, right? Because when we remove that buy to open put, when we remove that protection, that allows the broker to assign us the shares of stock if at expiration the stock price is below our short put, 32.50. So when we go back over here, I was assigned 100 shares at 32.50 because at expiration, my 32.50 put, the stock price was below 32.50. So they said, guess what? You own 100 shares at 32.50. But let's go back over here. I had $1.22 or $122 per contract or $1.22 per share. So if that's all I had right there, then they would say you own it at $32.50, but my break even really would be $32.50 minus $122, right? Is everybody with me so far? So then my break even would be $31.28 if I just got to keep all that. We're not taking this into account yet, but if I got to keep all that, I get to keep that money and I get to apply that towards owning the stock at $32.50. So now I really own the stock at $31.28. Is everybody with me so far? Is everybody with me so far? Is that kind of making some sense? Is that not making sense? If anybody, please tell me, guys, by the way, because honestly, I have all the time in the world this evening. And if anybody is bored, by this explanation and so on, I mean, just go for it. Tell me, because let's talk about it. Let's make sure that this works for everybody and that all these numbers make sense. So on my, I'm going to show you a visual example here that will make a little bit more sense. But I get to keep this premium. It's just how much more can I add to that premium, or do I have to take a little bit away from that premium because I lose money on this? So our buy to open put is going to affect either adding to this or taking away from this. So in this case right here, I got paid 122 bucks and I bought this for 98, but then I was able to sell that $98 put for $1.35. So I picked up an extra 37 bucks. So I put 37 on top of 122. You guys with me so far? 122 plus 37, 159. So we have 159. So now I get to take $1.59 per share and apply it towards this, I think. We'll see. 159 minus 32.50 puts us right at about $30.91. Does that make sense? Does that make sense, guys? Remember, we make small amounts of money on a credit spread because we're paid just a little bit more than we have to pay for our protection. Because if an option expires, if at expiration the stock price is above that 32.50 and of course above that $32, I lose all 98 bucks, but I get to keep 122 and the difference is only 24 bucks. If the stock goes the other way, then my protection is going to gain value. And if I say, hey, I want to own this stock, I'm happy my protection has gained value. I'm going to take that additional value and tack it on to the premium I was paid for my short put, right? So now I don't have to lose $98. In fact, I make money on that. Now I'm taking a chance, right? I could pull my protection off and the stock could just drop like a rock, right? So that's a chance we're taking. But so far it's been pretty decent, and we're kind of leaning on the fact that we're finding stocks that have somewhat of a trend, that are above the moving average, that are kind of in a bit of an upward momentum. And we're leaning on the fact that over time, most decent companies and decent stocks go up. So we're saying, yeah, we'll take a chance on removing the protection and owning the stock. So my protection that I paid $98 for, I'm now able to sell that for $135, tack on an extra 37 bucks onto my 122. So that's 159. That goes towards bringing that break even down, because if I remove protection and the stock is below 32.50 at expiration, the broker says you have to buy the stock at $32.50. And I say, that's fine, but I have 159 tucked away in the back that gets to be applied towards that break even price, bringing my break even down to $30.91. Does that calculation make sense? Does that make a little bit of sense? Some sense? Peggy, sold put minus bought put plus gain at assignment. I think so. I think so. Yes. So let's look at a little more visual example. So now just taking these numbers, subtract red, add green. Yes. Peggy, it's a good comment you made there, and I think you're right. But I want to go over some of the details here. But and yes, and Mel, as Mel said here, subtract red, add green. So yes, those are all good things to keep in mind. So now as we look over here at KHC, and I say, okay, Mr. KHC, I got assigned, and my break even is $30.90. But now I have sold a $32 call option for 96 bucks. So if I get out at $32, even though I was assigned at $32.50, right? They're saying that's how much you paid, $3,250 bucks. But if I get taken out at $32, some might say, well, you're losing 50 bucks on that trade. No, I'm actually gaining $109 on that trade, right? Because my break even is $30.91. And if I get taken out at $32, I'm $109 above my break even, or $109 above my break even. Does that number make sense to everybody so far? Is everybody kind of okay with that scenario? Is that coming through okay? So even though I'm selling a call option, hey Ken, nice to see you. Even though I'm selling a call option at what looks like below my break-even price or my purchase price of the shares, my break-even price is actually down here because of the profit I was able to take from both option legs of my credit spread. A credit spread on its own is opening two options together and closing two options together. Buying to open and selling to open, and selling to close and buying to close at the same time. That's a credit spread. What we do is we start off with a credit spread, but then we work it into a kind of a myriad of strategies, right? So when you take a leg off a credit spread, it's no longer a credit spread, and parameters change and all kinds of things change. And so that's what we need to calculate. Here is a And so this is how I would calculate this trade, right? I would say, okay, my break even's 30.91. If I sold a $32 call option, if the stock price is above $32 at expiration, they're going to make me sell it at 32 bucks. But 30.91 minus $32, I'm going to make $109 on the stock. And I'm going to make 96 bucks on the option, right? 96 plus 109. So then I get out with $205, right? So there's $205 that I make from a trade that only ever had a max profit of $24. I've turned it into a $205 trade. How many times does 205 go into 24 bucks? 8.5 times. I've 8.5 times my max profit of the credit spread. And that's why we like this strategy, because it takes a low risk credit spread and it turns it into, we can multiply that profit by 5, 6, 8, 10 times, right? So that's why we like the strategy. That's why it's so important to understand this strategy. But again, we have to be able to understand how to calculate that break even. So there was one example. Here's another example, right? Look at this trade right here. Here's a nice little credit spread running. This is SRNE. Again, another group trade that we have. SRNE is a credit spread. We've got 15 days left. Everything's looking good here. Okay, our max profit on this as it stands is $27 per contract. If this ends up above $10.50, we're going to make 27 bucks a contract. Okay, right? Oh, fine. That's what we were going to make on KHC, but now we're going to make 8.5 times more than that. But if we look at SRNE and we say, okay, we sold, that little -1 means I sold the 1050 put, and the regular one means I bought the $10 put, right? I sold the 1050, I bought the $10. So what my intention here sort of is that the stock can stay above 1050 at expiration. If it does, I'm going to lose $152 here. That option's going to zero out, but I'm making $179 here, which is where I get my 127 from, right? So this number right here under trade price that we see that says 27 bucks is the result of getting paid 179 and paying out 152. That's the difference. So the little parentheses here means that's what we were paid, and no parentheses, regular numbers means that's what we paid. Okay? And that's under trade price. So here SRNE is trading at 1039. So it's trading right between our two strike prices. So if I look at this and I say, okay, what am I going to do with this trade? If SRNE goes down a lot, let's say it goes down to $8, $9, $7, whatever, right? It goes down a bunch. If it does, then the $152 that I paid for my protection would be worth maybe 300 bucks, right? Right now it's actually down $47. I paid 152 for it. It's only worth 105 right now, so I'm down 47 bucks. If this stock dropped a bunch, then I would start to see profit here, right? Because this is a long put. A long put means if a stock goes down, the long put increases value. This is a short put. It means if it goes up, then the short put increases in value. So my long put right here says I paid $152 for this. So if the stock drops off the planet, I'm going to be able to make money here and apply it to the 179 that I was paid, right? So this $27 number right here only matters if I leave both legs as is. But the second I close my long put, then $27 is no longer a thing. We're not looking at it. It doesn't matter. It doesn't apply to our trade anymore. But if I leave both legs here, I make $27 or I risk $23. That's it per contract. But the second I remove this long leg right here, $27 goes away and we just see this 179. But the question is, did we add to 179 or did we take away from 179? Now, right now, if I said, hey, there's 15 days left, I just feel like SRNE is going to head up and run higher. And so I'm going to close this long leg because this is only going to keep pulling away from profit, right? If I let this run to zero, then all I can make on this is $27 per contract. But if I close my long leg right here, now, for example, I would lose $47, and that $47 comes from here. So let's deduct $47. 47 minus, so there's 47 minus 179. 179 gives me 132. So now I have $132 to deal with, which means if SRNE ends up above 1050 and I don't get assigned the stock, then I make $132 on the trade instead of 27. If SRNE ends up below 1050, then I get to apply $1.32 or $132 towards each 100 shares of stock that I own to bringing that break even down. So then if I own, if this is, expires at 10 bucks or 9.50 or whatever it is, I get to apply 132 towards 10.50. And so that makes my break even though I own the stock at 10.50, my break even is really $9.18. So to kind of give you a little bit of a visual here, this number, all we're looking at is this number right here. This is our gain or loss for our buy to open put. We're looking at this number and we're either adding or subtracting this number from our sell to open trade price put. So we're taking our profit or loss from the buy to open and we're adding or subtracting it to or from our profit from the sell to open. And then that's determining what this number ultimately is. Because if we close this leg and the stock is below 10.50, if I close my $10 put and the stock's below 10.50 at expiration, I'll be assigned at 10.50. But this number plus or minus this number will determine where our break even is. So if this right here, let's just say, for example, this is $47 in profit, right? Right now, our break even's $9.18, taking a $47 hit out of this $179 that we're paid. If that's $47 in profit, then I would say 47 plus 179 is 226. 226 minus 10.50, our $10.50 assignment. Our break even now would be 824. It's super simple math. It's the easiest math you can ever do. It's just we need to know what number to apply to what number. And that's how we calculate our break even, is we say, do we have profit or loss here from our buy to open put? Do we have profit or loss there? If so, we add or subtract that to this 179 that we were paid. And that will tell us A, how much we get to keep if this ends up above our short strike, or B, how much we get to apply if we get assigned the stock because at expiration we're below our short strike. How does that make sense? How's everyone feeling about that? Raymond says, how do you calculate 205? I calculate 155. Raymond, I'm not sure what you're saying there. Give me a little more, Raymond. Go back on that and just tell me a little bit more, because I want to answer every question and I want to demonstrate and talk about how we do that. Previous example here, as in the previous example on SRNE. Did I get 155 on something? Oh yeah, I did get 155. Well, I don't know, did I? So I get 155 by saying 47, that's our loss, minus 179, which we were paid for selling that put, minus 179. Well, I get 132. I don't remember where we got. Did we get 155 out of KHC? 205. I might have said 205, saying if this was $47 in profit, to just kind of show an example. So that might have been it. It might have been KHC though. And we can go look at KHC again. Oh yeah, KHC example. Okay, yeah, we'll go look at that again. Peggy, us old folks need decimal and plus or minus in a specific order. All right, I'll do it. And remember, guys, we're in option trading and stock trading and so on. It's always, it's always per share or per 100 shares or per contract. So it's either 1 or 100. So that's why I just leave the decimal points out. But so if we go back to the KHC example here, which is right here, The KHC, David, the 105 is a total profit on KHC. Okay, all right. Yeah, thanks, David. Okay, let's go back and look at KHC for a second. And like I said, guys, we will take all the time we need because this is a super, super important concept that we need to make sure that we're super clear on. So KHC, we were paid 122, we paid out 98. So first of all, we have to say 98 minus 135. We paid 98, we sold it for 135, right? That's our protection. So 98 minus 135, right? And that's where we get 37. So we gotta determine how much we paid for our long put. We paid $98. We sold it for $135. So we got 37 bucks there. So $37 is the profit from our long put. $98 bought, 135 sold. So we get we get the $37 profit from there, and we add it to our 122. 122 is what we were paid for selling the option. 122, and that gives us 159. So there wasn't a, was there? Oh, and then the 205, that's right, that's where our 205 came from. So then on KHC, so between our options, the short option paid us 122, and then we picked up another $37 in selling that put that we bought for protection. That gave us an extra 37 bucks. So now we have 159. So now we're going to get assigned at 32.50. So 159 minus our 32.50 assignment, we're assigned at $32.50, puts our profit, or sorry, our break even on the stock at $30.91, right? Because we get to apply 159 to, we get to subtract 159, which is our option profits on both sides, from the stock price of $32.50. So now, knowing that our break even is $30.91, I'm selling the $32 option, or $3,200, but I'm selling the $32 option. And if I get taken out at $32, my break even's $30.91 minus 32 bucks, so I get $109 in profit. Plus, I get $96 for selling a call option, for doing a covered call, plus $96 for selling a call option. So that's a covered call. So I sold an option, so I get $109 in stock profit, and I get $96 in option profit. And that's where I get $205 from. Does that make sense? Does that answer the questions on that one? I think it's good to just run over these numbers again and again and again, because, you know, once again, more people than not don't understand how to calculate the break even, and that's totally okay. And that's why we're doing this webinar. Does that make sense? Raymond, David, Sharon, Peggy, anybody, everyone feeling good about that? I'll wait. You guys can answer. Does it make sense? Does it sound good? Everyone? Okay, breathe it in, Raymond. Breathe it in. It'll take a little bit of time, but it's recorded, and this would be a good one to go back and review again. Last two steps again are, what is our break even on the stock? We took option profit, we applied it to our $3,250 assignment, and that brought us down to $30.91, because we were able to put $159 towards $32.50. So that brings us down to $31.90. I sold a $32 call. If this ends up above $32, they're going to make me sell it at 32 bucks. So I'm going to make $109 on the stock, and then I'm also, this is a covered call, so I sold a call option for 96 bucks. So I make 109 plus my $96 in option profit, because I sold an additional covered call. That's an additional step. That's not a put. We started off with two puts, and then when I got assigned, I sold a call option for 96 bucks. And that's where my profit's coming from. Let's see here. Okay, good. My pluses and minuses are sometimes confusing, but I get your numbers. Okay, Janae. All right, that's a good comment. That's good. You have two short legs and will be assigned to buy the stock 2 times. No. So no, Amy, no, we have one long leg and one short leg when we start the trade. So we sell a put and buy a put, and then we have we close our long leg. We close our long leg, and then we're assigned at the short leg strike price. And then I short a call option. I'm selling a call option, but I own the stock now, and that's what a covered call is. Gotcha. Oh, Raymond, good. Sometimes you gotta let it sink in. Raymond's getting it. That's excellent. Very good. Lori, agree. Want to add if no parentheses. Parentheses are important because that lets us know if we were paid or if we paid. And Lori, I know you have an accounting background. Forget about the parentheses in typical accounting. Parentheses in trading, which is the only thing that matters in this example here, is if a number is in parentheses under our trade price, that means we were paid that amount of money. Right here, that $3,250, that means I paid $3,250 for stock, right? So I paid that out, but I received that in, right? I was paid that money. David, the second short means you have to sell the stock, not buy it. Yes, so my second short, which would be the call option, means I have to, if the stock price is above, if I'm short a put and at expiration and I just have a short put and I'm below that short put strike price, then I have to buy the stock. If I'm short a call, if I'm below this price at expiration, I actually get to keep my stock and I just keep my option money. If I'm above $32, I keep my option money and I lose the stock at 32 bucks. Yes, was that your question, David? Does that make sense? Does that help? Hopefully, or not hopefully. I mean, like I said, we'll discuss it as much as we need to, but was that your question? Is that kind of what you were asking? The second short means you have to sell the stock, not buy it. Yes, exactly. So hopefully, so let me know, David, because I'm happy to go back over that. Amy, so you close the long put with extra premium by sell another put. Yes, yep, exactly, Amy, yep. Peggy, opposite from everywhere else, the parentheses. Exactly, Peggy, exactly. Raymond, what was the premium from the sold call? The premium's right here. So it's in that trade price, right there. So that's our premium. Oh, okay, David. All right. I was clarifying the person who said the short legs. Yeah. Okay. Good. Exactly, David. Yeah. Thanks for saying that. Exactly. Perfect. Okay. Good. Is everybody feeling okay so far? Are we feeling a little bit more able to calculate the break even? It's so super important that we understand how to do this, because this is the foundation of everything with this strategy, is how to calculate break even. Amy, do you buy the call and a covered call instantly, immediately? Amy, as soon as we get assigned, we need to determine where our break even is, and we're going to sell a call option. We're not buying it, remember, we're selling it. We're going to sell a call option one strike higher than our break even, or one strike higher than the current stock price, whichever is higher. And we do that immediately. We'll be assigned at the close on Friday, and we do that ASAP Monday morning is when we sell that option. Yep. Does that make sense? You guys all okay with that? Is that working so good so far, so good? So again, how do we calculate our break even? We take this number. David, let's see. Say that again about where you sell the call. Yes, okay, David, it's a good one, and it's probably worth writing down here. Maybe I have in the past, but let's write this down, because that's pretty important. So when we're determining where we're going to sell our call option, so for covered calls, we're selling a call option either one strike above our break even of the stock price, or one strike above current stock price, whichever is higher. Super important. Is whichever one word or is that two words? Is that one word? I think it's one word. I don't really know. So whichever is higher, right? One strike above our break even. Let's say our break even's at the stock's trading at $32 and our break even's at $32. So then we'll sell the $32.50 or the $33, whatever the next strike up is. But if our break even's at $29 and the stock's trading at $30, then we're going to put our we wouldn't want to sell like the $29.50 because that's one strike above our break even because that's still below the current stock price. We can make more money if we sell a strike above where the current stock is trading. So if our break even's 29, our break even's $29, the stock's trading at 30, we're going to sell an option at either 30.50. That's supposed to be at 50 or at $31, whatever the next strike up is. Okay, so that's our break even. That's where the stock's trading. That's where we're selling our option. One strike above, whichever one of these two is higher, whether it's our break even or current stock price. Okay, does that help? Is everyone good with that? Everyone good with that concept, with those numbers and so on? Everyone feel okay about that? Okay. Now, yes, Mary, good question. Why only one strike and how far out? So typically we're trying to go out about 15-ish days, right? Or 2 weeks. So, sometimes the 2 week-ish out expiration is going to be 16, 17, 18 days. We're trying to go about 2 weeks out. And the reason that we only go out about 2 weeks is because we don't want to, with this strategy, we don't want to be tied up in positions for any longer than we have to be, right? There's another strategy for selling covered calls where you say, hey, I've owned this stock for 5 years and I bought it at $10 and it's worth $100 right now. So sell some options on it. Sell some 110, some 115, some 120 options because you want to keep it. You're just trying to make a little extra money while you hold on to it. Great, that's totally fine. This strategy is using the purchase of stock to turn a losing trade into a winning trade and to make a losing trade more profitable than a winning trade, but we don't want to hold on to it for very long. And so that's why we're only going one strike above and we're only going 2 weeks out because we want to get out as quick as possible and free up that money for the next trade. So typically, I don't want to go 2 or 3 or 4 strikes up because most of the time I just want to get out of the trade fairly quick and move on to the next one. Does that answer your question, Mary? Janae, hat, is that how or that? Okay, so is if you want to have a stock called. Yeah, exactly, Janae. Yep, that's if you want to have a stock called away, you go shorter expirations and closer to the current stock price, which is what we want. We want to get the stock called away. That's the goal. Okay. I want to make sure that Paul. Hey, Paul, nice to see you. 2 weeks out is because 2 weeks out is where we can make enough extra money. It's kind of our sweet spot for option premium, right? So if you look at here's 2 weeks out, around an at the money option, paying about we'll say $90 on this one. 1 week out, we're paying $30 on that, right? So we're making 3 times as much going an extra week out. We start going 24 days out, we're not making that much more money. 3 weeks out, we're not making that much more money than 2 weeks out, right? 2 weeks out, we're making, around $90. 3 weeks out, we're only making another $10, $15. But 1 week out, we're making a third as much. So 2 weeks out is kind of that sweet spot for making about as much as we're going to make without having to hold on to the trade forever. So 2 weeks is really that kind of optimal area of option premium without having to hold on to it for too terribly long. Peggy, if you're asking about trades in the trade group, I don't think we have anything expiring tomorrow. No, we don't. Mary, why do we necessarily want to get the stock called away? We could just do 2 or 3 covered calls and make more money, or is it only an advantage if we have lots of better alternatives? So presumably you are assuming that there are other ones that will make more. I'm not presuming there's other trades that will make more. Um, I just want to free up all that money, right? Because when we get assigned shares of stock, we're tying up a pretty good amount of money. I want to free up that money for other trades that may just end as option trades, right? So, but that's not a I mean, that is a pretty crucial step, but that can also be account preference, right? Some people in my trade group have $5,000 in their trading account. Some people have $500,000 in their trading account. So for those that have, 100,000, 200,000, 500,000, a million, yeah, you can hold on to the stocks a lot longer if it's not tying up your money, and you can make a pretty significant amount of money from that. But for those that have smaller trading accounts and may only have 5 or 10,000, you want to churn your money. You want to free up all that. You might be holding on, $3, 4, 5, 6, $7,000 in stock in money to hold that stock open, and you want to free that up to get into the next series of trades. But that's also something that is personal preference. If you say I've got enough money and I don't have any other trades I want to get into, and I'm just going to keep selling options, that's fine as well. Another thing to think about though with a stock is, the longer you're in a stock, the more exposed you are to some amount of risk, right? There's always that unpredictable reason or that unforeseen reason that a stock might drop suddenly for one reason or another. Accounting fraud, CEO gets in a car accident, whatever. I'd rather not expose myself for any ultra extended period of time on a stock that I'm kind of getting into with the intention of keeping it short term. Now, if I'm going to get into a stock and plan on holding it for a year and a half, or 5 years, or 10 years, or whatever, I'm going to do a lot of extra research about the company and so on. But for this kind of strategy, we're more looking at some of the basic numbers and the basic technical analysis and saying we're anticipating getting in and out of this quickly. Sharon, with your own trades, Alcoa and Bank of America should be assigned, and maybe they'll be assigned tomorrow. I remember looking at your account. I think those will be assigned for you, but those are not, group trades on my part necessarily. So on your own trades, yes, I think you'll get assigned. I think you'll get assigned on both those tomorrow, which is good, which is great. Okay, but back to the moral of the story here. Does everybody feel like they can calculate break even? Do you feel like you can calculate break even? It's the thing that I want everybody to look at it's this number right here. This is your profit or loss from your long buy to open lower strike price put. Your profit or loss gets added or subtracted from this number right here. We add it to this number or we subtract it from this number. And then we apply that amount, whether it's more or less, right? If it's 179 plus, 10, then it's 189. And we get to apply 189 towards 1050. If we have to lose $10 and it's 169 now that we apply 169 towards 1050. That is how we calculate our break even. The profit or loss here, added or subtracted from the profit or loss here, and we subtract it from this number right there, which is where we're going to get assigned. So add or subtract this, to or from this, subtract this final number from this. It's really that simple. It's those 3 numbers. That's all we have to look at. So I'm going to subtract, once again, just to show the example here, I'm going to subtract 47. That's my current loss. If I close this out right now, I'm going to subtract 47 from 179, which gives me 132. And I subtract 132 from $10.50 or $1,050, right? So subtract that from 1050. My break even is $9.18. Is everybody with me on that? Does that feel good? Does that seem good? Do you feel like you can repeat that on your own? Yes, no, maybe? Amy, can I sell the stock right away once after assigned and it takes 2 trading days to execute the purchase? Is the capital not tied up? So, Amy, that could be the case with your broker. It's not the case with Tastyworks. So as soon as you as soon as you sell it, the money's available immediately with Tastyworks. Other brokers might have other restrictions and regulations and so on. Okay, Raymond, not quite. We made $37 selling, bought, put, kept 122, premium sold, put 159, and we made 96 on the covered call. Yes. We made $37 selling the bot put. We kept 122. Those two numbers together make 159. We apply 159 to 3250. We deduct 159 from 3250, which gives us 3091. And then if we get out, so Raymond, you're leaving a step out here because we're selling the $32 call. So if we get called away at $32, then that's where we have our 109 plus 96. So you're leaving out the $32 call option that we sold. So the difference from $30.91 to $32 is what you're missing there. Does that make sense? You're just missing a step. That's all. But you're on the right track. Does that help? Does that make sense? So you're forgetting the it's all right, Raymond. That's cool. So remember on KHC here, so now our break even is $30.91 and we sold the $32 call. $30.91 is our break even and we sold the $32 call. So if we get forced to sell a stock at $32 now, $30.91 minus $32 is $109. $109 plus the $96 we got for selling that option is $205. So it's all there. I'm less concerned about you understanding that part though. I'm more concerned about you understanding how to determine once we get assigned. But hopefully that makes sense. Does that make sense, Raymond? I mean, it's the difference from where our break even is versus where we have to sell the stock because of our covered call. Okay. Okay, Janae, yeah, thanks for clearing up the pluses and minuses and parentheses. Okay, does everybody feel more well-equipped to calculate their break-even? How do we feel on that? Do we feel more well-equipped to calculate our break-even? Okay, okay. Okay, keep nibbling, Raymond, keep nibbling. Good. Does anybody have any final questions? Anybody have any final questions regarding how to calculate our break even? I'm just going to say it one more time. Add or subtract this number from this number, subtract this number from this number. That's how we calculate our break even. Tell me about it. It's 4 o'clock somewhere. Hey, it's 4 o'clock Pacific time right now. That's happy hour. That's good. Okay, guys. I was going to talk about the state of the stock market. I'm not going to do that because I'm tired of talking, but it was lovely being with you all today. I hope that was helpful. I really hope it was helpful. I hope I answered everybody's questions. I hope everyone's got a little bit of a better grasp on how to calculate break even. It's so important, and it's something that still so many people struggle with, which is why we do these webinars. Okay, that's it for me, guys. Have a lovely, wonderful, fantastic, excellent Thursday. For those in the trade group, we'll see you in the live webinar Friday morning. And otherwise, thanks, guys. Take care, everybody. Have a wonderful rest of your week and a good weekend. And see everyone back here on Monday. Take care, guys.